freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, along here with Adam Penn. Hi, Adam.
Hey, Dustin.
How you doing today?
I'm doing great. This is our first episode.
I know. I'm actually quite excited about this. We've been talking about this for a while. We're making it real.
So why don't you start with why we're here and what we're doing?
Yeah, well, no, that's an excellent place to start, right? So yeah, I mean, I think the wealth independence kind of reflects a very high level worldview of ours, and sort of two words that kind of mean a lot, right? Wealth and independence. But I think our little tagline, right, where freedom leads and real wealth follows. We'll dive into that in probably more detail in a little bit. But the quick idea there is that most people think that you need to have wealth in order to have freedom, but it's actually the other way around. If you don't have freedom, you don't have the freedom to build things, to actually create that wealth, you'll never have wealth. There's plenty of examples throughout history where that was the case, and very recent history even, where some otherwise wealthy folks in some not friendly governments sort of stepped out of line, and the government smacked them back in line and really proved that they didn't have the freedom and they didn't have the ability to continue growing. So not to make this an overly political show, but we certainly want to keep in mind that without that baseline freedom, the real wealth is really impossible. And I think to kind of talk a little bit about why now, I think this was that you and I've obviously spent some time together and talked a whole lot, and feel like we've got some decent perspectives.
We are good at just talking.
We are good. Yes, that's for sure. And not only just like our perspectives, but the perspectives that where we both come from kind of a tech background. And so then being able to apply that knowledge and mashing up the finance worlds and the investing and real estate worlds and things like that. So I think it's...
because I think with both of our backgrounds being in tech, we have this desire to really speak to kind of tech professionals, right? Everyone's got a different way of looking at things, but I think the people that we normally find ourselves in conversations with want to have a more in-depth view than maybe some others, right? There's types of investors out there and people looking into these different types of alternative investments where they have they just want to know what the return is, right? They want to know it's a 15% return. And then there's other people, primarily engineers and people like us, and that want to know every little detail. And it's funny when we see some way that other people underwrite deals and look at news articles and things, and the way that we do. I think really our goal here is to provide a more in-depth view into some things and talk about some technicals and really be focused on how we see investing.
Yeah, absolutely. Well, with that, for this intro episode, I figure it's a good time to dive into our backgrounds a little bit more. You want to kick us off?
Yeah, sure. So, I mean, like Dustin said in the beginning here, my name's Adam Penn. I got my computer science degree from Chico State. I did that and graduated 2017, I believe. Been a software engineer for that time. Was a full-time software engineer. Started buying real estate, built up my passive income to the point where it made more than my W-2 income. Got left/fired from a job. That might be a story for a different time. And then took some contract work. I still do a little bit of contract work here and there, but primarily, we run, me and you collectively run a private equity firm and a short-term rental management company, managing real estate both for our investors as well as doing asset management on the deals that we own and looking for more investments.
That's awesome. I don't want to turn this into an interview, but I do have a couple of questions on your background. I think you've talked before, you don't like to use the term, but you kind of like when you were in school and were starting investing, you were kind of house hacking, right?
Yeah. So, I mean, I had a high income. I was able to buy properties at 5% down. and then fix them up, rehab them, get them refied, get my money back out and buy another one. So yeah, very much that house hacking. When I went into the computer science, I actually had a friend in college who came out of private equity, and he hated private equity. He hated bankers, he hated finance, he hated all of it. And he was like 40, and he was a Wall Street guy. I mean, he was making a lot of money. And he went into computer science, and we were in the same class together. And I always told him, yeah, I don't really like computer science. I mean, I don't mind it, right? It's kind of fun, but it's not my passion. And I'm just doing this because I'll get a good paycheck, and then I can go build a real estate thing. And it was funny to see our paths, thinking back to that, almost eight or 9 years ago, how he hated this space and moved into computer science. But obviously, he was still wealthy and wanted to, do investing and things. But he didn't like it as a job. And how I kind of, merged and crossed and changed right along with him.
That's funny. Yeah, no, it's always interesting how it takes some experience sometimes to kind of figure out exactly. And I've kind of got a similar story myself, where you have to kind of get out and do some things to understand a little bit more about where your true passion lies. I do have a question, simply because we do have more of a tech focused audience. What languages do you typically program in? Are you proficient in? You got experience in?
Proficiency is an interesting word, but I've done a lot of web development, so backend.net and a little bit of Java, a lot of Angular, things of that nature. I think I had a one-line change accepted to the Angular code base at one point in time. I'm sure it's been wiped out since then, but done basically all web development.
Gotcha. And ChatGPT for the rest, right?
And ChatGPT to do almost all of it. I mean, as soon as that came out, the job got easy. Yeah, every other tech person on here. I mean, I think the investing really is that once back to the freedom, right? If you're scared about AI wiping out your job or anything, having another source of income really helps. After a few years into my career, I was no longer worried about getting fired or having a job or any of that.
That's probably a whole episode in and of itself, that concept right there, right? And like the freedom that's now real freedom, right? Like when you're no longer worried about sticking your head up or making a stink about something at work, because you're like, okay, well, if I get fired here, it's like it doesn't change things for my life, right? I've got this other source. So that's huge. Anything else you want folks to know about you?
No, not really. What else about your background, right? You were part of a big tech exit.
But I guess my background was more of the traditional kind of corporate path. I grew up in East Tennessee, went to the University of Tennessee, graduated with a finance degree, and I was recruited by Deloitte right out of school. Interned with them between my junior and senior year, and then joined full time in Atlanta right out of school. And that was good. Deloitte was a very good place, I think, to launch a career. Honestly, from just the name recognition, that alone, I did not appreciate the time. That even still today, that I'll mention to people that I worked at Deloitte, and they're like, "Oh, really?" I'm like, "Oh, yeah." I had no appreciation for that immediately coming out of school. Again, my accounting friends were much more like, "Oh, you got an internship at Deloitte," and I was like, "Yeah, you know that?" And they're like, "Oh, yeah, it's Big Four." It was all lost on me at the time, but certainly very, very thankful for that now. But I went into a role with them in IT audit and consulting, and it was really kind of this mashup of like my formal business education and me being just a nerd growing up. I'd always been interested in computers, tinkering around since I think we got our first computer when I was 5, and I started messing around. And before, my parents had worked on computers at work, and within about 6 weeks, I knew more about everything on the computer than they did, even though they used it every single day. Took a programming class when I was in high school, learned the basics of programming with Visual Basic 6, which was great language and came in still comes in handy for Excel macros, since that's the base language that's used there. But that really taught me kind of the basics of how to think about programming logic and things like that, which still come in very handy to today. And then there was the little parts of my background like that ended up serving me well in that first role at Deloitte, where I'd done that. I could actually look at code. I could look at a script. Somebody could show me a SQL query. And unlike, quite honestly, most of the rest of my coworkers, I could look at it and understood what was going on. Whereas most would just nod along and be like, okay, look, that's the same as last year. So, okay, we're gonna move on with that one. So it was really good. I worked for the IT department in my for the school system in my hometown growing up, and so again, like had this informal tech experience and formal business education, and that kind of came together very nicely for me right out of school. So I was working for Deloitte's a big corporation. Worked for them for a while. Ended up going to work for a smaller company doing kind of the same thing, and then after that, I went to work for one of my clients at that company, which was McKesson Corporation. At the time was number 5 on the Fortune 500, very large company. I think if you've never heard of McKesson, that's fine. But if you've ever had a prescription filled at CVS, you've been impacted by McKesson. They transport about a third every day of the nation's pharmaceutical supplies. In addition, you've probably been sitting in a doctor's office and seen a box that says McKesson, a box of gloves or something like that. So big company, worldwide. Was very much the corporate sort of thing, and it was around that time that I've got so many stories from like what kind of has led me here to this alternative path. But it was around then. It was actually when I was at McKesson that I became interested in real estate and actually seriously started pursuing that. And it was as a result of really a life event. I watched my maternal grandmother, so my mom's mom, watched her run out of money. She outlived her money. She had a retirement, had a pension, and had a large farm that my mom grew up on, and they sold that, and she kind of lived the last couple decades of her life off of that money, and it ran out. She ended up outliving all of that, and I mean, she lived a very modest life. And I watched my mom and I watched my aunts and uncles have to make some really tough decisions about care for my grandmother. And it was all based on the constraints of how much money was available. And then, okay, well, can you contribute this much, and can you do this? And that really made a huge impact on me. And after I helped my mom with some things on that, and then that really solidified in my mind. I don't want to be in that position, not just personally, but I'm an only child, so I'm going to be taking care of my parents, and I don't want them to be running into that same position as well. I think especially as we've advances in medical care and people start being able to live longer, I think that's going to become more and more of a thing where a lot of the traditional financial planning folks are going to start outliving that, especially if you don't have consistent sources of income. And the idea is to just be drawing down a nest egg. And so that, again, that made a huge impression on me. And I was like, okay, I've got to find a way to make sure this doesn't happen. A lot of wealthy people in real estate, so I'll take up real estate. And so, of course, there's, the real estate and passive income, and it's the easy path to wealth and mailbox money, and there's never any struggles or anything like that. But I dove in head first, got involved. I was living in Atlanta at the time, got heavily involved with the local RIA there. It's known as Georgia RIA. And that was really the start of my education into this space. I knew enough to know that I didn't know anything and wanted to learn before I started investing large sums of money. And it was really instructive. I learned a lot of, basics, just listened to Bigger Pockets podcast, did all the normal newbie stuff. And I realized very quickly that buying single family homes and kind of going that path, using my own money, qualifying for mortgages, standard residential mortgage on my own, buying a single family home, I realized that was not going to scale to the point that I wanted it to. And to really, there was a mismatch between that path and my goals. And that led me over to the commercial side. I had heard some folks reference commercial real estate, and I was never really afraid of the numbers. I think some folks they're like, oh my word, a $1 million apartment building, that's crazy. And that never really scared me off.
The best and final that we just got accepted for $32 million. That one's still a little scary.
Yeah, that one definitely was scary. It's at some point it is, but just the sheer size of the numbers was never something that I freaked out, and I didn't have a lot of limiting beliefs around I can't do that, simply because of the price. But it was actually one of our mutual friends, Anthony Chara, was presenting at a Georgia RIA event, and he kind of explained the math behind commercial real estate, how it's valued based on NOI, the net operating income, and the cap rate, and how those two things work together. And he gave an example of, reducing landscaping costs by $200 a month, and the impact to what literally just making one phone call to change a landscaper would add $60,000 of value to an apartment building. And I thought, oh my gosh, this is absolutely the place I got to be playing in. And so really then went down the path that way, and that's kind of a long-winded way of what's led me to here, but love real estate. I love commercial real estate again for that reason. I'm sure that's something we'll dive into in the future, is that ability to force equity by simply improving the operations of the property or doing things to cut costs. There's just so much more flexibility, and there's so much more wealth creation opportunity in the commercial space as opposed to just buying single family homes one at a time. But that's really
I think on that note, why don't we talk about kind of the big problems that we see, and maybe more from your side. I think I did a little bit of a slower transition out of the workforce than you did. What are some of the issues you see, or kind of the myths around alternative investing, golden handcuffs, and just what you see for people in the tech space?
Yeah, I definitely completely glossed over that, right? Where I joined a startup, and we had an exit in 2020. So I was with Segment, and we got acquired by Twilio for $3.2 billion, which is a very big number, talking about big numbers, in 2020. And it was a very interesting experience to go through that, especially going through that in 2020 and kind of swinging from is the world going to end to, or is our company going to have revenue, to we get acquired for a very large number. But you mentioned a kind of a swift exit from corporate life. I did. I completely left, stayed on with Twilio, had some golden handcuffs as you referenced, but left Twilio in July of 2022 to focus full time on real estate. And I do think, like, I experienced firsthand that the golden handcuffs effect. Not only just from an equity standpoint, but just the salary, right? So many folks in tech are just making a lot of money. And we talked earlier about ChatGPT and how that's kind of changed things and can speed things along, or depending on your role, maybe it means that you aren't doing hardly as much work as you had been, right? But you're still getting paid a lot. And it's really tough, even if you are in a situation where you don't enjoy what you're doing, you don't enjoy the people, you don't enjoy the company, whatever. It's tough to walk away from that. And it's like, I think that whole space, the entire environment around, not so much, where you earn your money and your salary, but how you invest it, right? Like, there's an entire education ecosystem around, well, you invest, of course, you invest in your 401k and you take the company match, and then you invest over here. You make sure to throw some in a Roth IRA to get some of the tax benefits there, and you save in your HSA. And then if you got anything left, you dollar cost average into an index fund in your individual brokerage account. And that's the advice that is given as the default. And there's a massive ecosystem around ensuring that is the advice that remains prominent, right? Wall Street has a very strong effort in those the education efforts. They have a very strong hand in those education efforts, and they ensure that as much money flows to Wall Street as possible. And that is a limiting factor. And you have a lot of folks who don't realize that there's even alternatives outside of that, right? There's a reason that this space that we play in is more broadly known to the big investing world as alternative investments, right? And I think you and I kind of disagree with that framing of it.
Yeah, it's a funny sentiment, right? Because I mean, real estate in general has been the thing that the landlords, right, the lords of the land, were the people with the money, and for thousands of years, anyone that had real wealth was stored in not paper assets, not the stuff that most people nowadays store all of their wealth in, whether or not that be fiat currency to stock portfolio. It's none of it has intrinsic value.
That's exactly right. And, you've got a kind of a backwards incentive structure, right? Where the folks who are, the folks who you really, again, most of the world in the traditional sense, they look to as your financial advisors, your CFPs, right? People who have professional designations. I don't know if you've ever looked into this before, but the actual CFP curriculum covers all sorts of things. And there's one tiny section for alternative investments. It's basically like a little throwaway thing. And so even the folks, if you look up to, well, my financial advisor's got all these experience and does this, and he has this designation, you kind of have to remember what he has been educated by. And it's by this system that is designed to funnel as much money to Wall Street as possible. And even more so, a financial advisor, because a lot of times they make fees based on the amount of money, the amount of your money that they are managing, that they keep funneling into those investment products. they have no incentive to tell you about things that they don't make money on, right? That's the incentive structure is completely backwards.
It's a very unique thing when you find a financial advisor, and we know a few who even point people towards our deals, and they lose money on their personal income side by pointing people towards these types of deals because the system's not built, they can't be in compliance and still run them.
That's exactly right. And it's, for the ones who are willing to do that because they see beyond, they're like, no, I'm helping my clients and I want to provide what's best for them. It's amazing. And obviously we love the guys who do that, but that's a very tough decision when you sit there and say, well, if my client moves $500,000 of their dollars over here and you're like, oh, I'm making 2% on that per year. And then they start doing the math about how much money they're going to lose. Even otherwise well-meaning people are very easily incentivized to just stay quiet about this world, even if they know about it and know that it might be better for one of their clients in a given circumstance.
So do you want to talk a little bit about how you have transitioned into doing, more real asset investing? When people ask me what I do, I say I raise capital for cash flowing, tax beneficial investments. And what does that look like kind of as a tech professional might start investing in some of these, the due diligence they'd look at, maybe a little bit around analysis paralysis and things of that nature?
Yeah, I mean, this space, we're talking about it being alternatives and not well known, right? A lot of people, when they discover it, they come in with a fairly low level of education. And so it's kind of like the initial thing in my mind, if you don't have a lot of exposure to this space, is to start learning, because it is a very lucrative area, and you have to be mindful that there are bad actors in this space, and there are bad investments. There are bad investments from good actors, right? And so you kind of have to be able to discern not only the operator, the person that you're partnering with to invest in, not just them, but their deals. And so there is that education component to where you want to get good at looking at deals, at understanding markets. It's definitely nowhere near one of the reasons I love this space for, really time-strapped folks in tech or in any profession in general. If you want exposure to this space, you can get it completely passively, right? But you still have to do a little bit of due diligence. And so like that upfront diligence on kind of knowing what to look for, knowing questions to ask, that's a huge one. You can fairly quickly interview a potential operator as you can kind of have a list of questions to ask them to look at a deal. And so I like to say it's 100% passive. Maybe it's 99%, right? You need to evaluate the deal and make a decision on your own. But that's really the first piece, is learning what to look for, learning the questions to ask, and then being able to implement that, and then just enjoy this space and getting all the benefits of having done the work yourself, but you're not actually having to do any of that boots on the ground type work.
Well, and I think part of that is, Ken McElroy, an advisor of ours, says, only invest in the things you understand, right? Or better yet, he says, don't invest in the stuff you don't understand. And I think this is a space where, as long as you understand what you're doing, you understand the investment, you don't have to understand how to operate it, right? You don't have to go out there and know how to rehab the house, right? You don't have to know how to, drill an oil well or produce it into tanks and get it out to the refineries. But you should understand how that works, and really a lot of it around risk mitigation too, right? So do you want to talk a little bit kind of about our investment philosophy, maybe around kind of freedom first principle, and then going into anything else?
Yeah, for sure. We mentioned that at the start of the show, right? And that in general we want to have a philosophy and a worldview where we pursue freedom first, and then knowing that the wealth will follow, and not to get those two things around or backwards. That said, obviously we live in a very material world, and it takes cash to live. And if you do have money, then there's that buys a level of freedom. Freedom mainly around your time, how you spend that, around the decisions that you make, who you spend time with, what you say yes to and what you say no to. And so I think that's one of the reasons that we talked earlier about being able to have some flexibility to, again, say no, right? And if there's something that comes up, or you need to make a stand for something, you're not concerned about losing your livelihood over that. And that's a really That's one of the reasons I think from our investment philosophy, we focus more on cash flow. We love cash flowing investments. And that's a big change from someone, if you've never really thought about that and you've only ever invested in stocks, invested through your 401k, you're likely not very concerned with cash flow, right? That's the stock market on the whole is mostly a equity growth game where you put money in and you hope over time it grows, and then at some point you start selling those things and take those profits.
And even if there is a dividend portion to it, it's very small, and you're still betting a lot on equity on the tail end versus, getting most of your returns from cash flow, right? I mean, the private credit fund we're working on is 7%, 6% cash on cash that's getting paid to you, and then upwards of 11 to 13 on the tail end. So, that's all, it's all cash flow, right? It's all debt payments, mezzanine debt, which is a totally different theory to think about than being an equity play and just waiting for it to sell it one day.
Absolutely.
Right? You're realizing these gains in real time.
Exactly. And the other difference too, even in some high yield type stocks, some REITs can have a very high dividend, and you've got these I forget, JP Morgan had their investment management, they've got a well-known ETF that's a fairly high dividend. But what you miss is these are still publicly traded products, and so therefore they're subject to market volatility. And so when we have a situation where if there's a panic or everyone starts selling, or just in general, like there's a lot of ups and downs in the share price. So you might get a decent dividend, but if you ever go to sell it or you ever need that cash at some point in time, you don't know actually how much you're going to get back out. Are you going to get your original investment? Maybe it will have appreciated, maybe not. And that's one of the reasons we like these private investments. They're not subject to that level of volatility. And I'm certainly the type of person that, you're not supposed to check your account balances every single day, but I do, right? And I don't like volatility. Some folks can handle it more than others. I'm not one of those. And that's again, one of the reasons that led me to this space was getting cash flow without that volatility. And you can make an argument that, well, the S&P's returned a ridiculous number the last few years, and that's way more than real estate, and that may be true. I mean, it is true, but I also think that it's an aberration. I don't think we're going to continue to see that over the long run. And so, you can kind of
get all an equity play.
And that's exactly the point I was going to make. That's still all, those returns are still all equity, and so they require you to sell the asset to realize the equity. So if what you're trying to do is replace your income, or have some kind of security from job loss, if you're trying to just supplement income to help with lifestyle, you want to travel or whatever like that, it's hard to you can't do that in the public markets in stocks and ETFs without actually selling the asset, and then you break the compounding, and there's all sorts of negative things. So I think we've kind of beaten this one pretty good, but we like cash flow. Those are the investments that we personally like, that we like to own in our portfolio. We're not looking for, you and I, Adam, we don't do development. We're not here to have some ground up development can be very, very lucrative, but it's not a cash flow play. There's every bit of that return is made at the very end, and nothing wrong with that. But those are not the types of investments that we like and that we pursue personally.
So I think another thing to talk about is why, and it ties back to kind of a reason to do this podcast, right? A reason we do our newsletters and all that stuff, right? Is kind of the power of the group, and not just going out and buying a single family home and being an only investor. Partially due to the fact that, you can take down a bigger deal, right? If you have $100,000, you could go buy a single family home. But if you invest in a private placement for an apartment building, you could be a partial owner of a 300 unit apartment building, or even the small one, let's say 40 unit, 20 unit apartment building, and own, 5-10% of it. And then you have more diversification across a larger asset. You don't have just one unit. You're not having to do all the work. The returns could be slightly lower. They could be higher, right? I mean, it just depends on the deal itself and how much you want to manage it, how well of a job you do managing it. So maybe talk a little bit about just the kind of going at it alone versus having a community and having different thoughts.
Yeah, for sure. Real estate especially is a team game, whether you're doing it by yourself or not, right? Like even if you try to do everything by yourself, you're probably You're probably going to leverage, let's say, a real estate agent to try to find you a house to buy. Maybe you're swinging the hammer, but Adam, you're very handy. But even for the work that you do, you don't do it all, right?
Nope.
Even when you've done things ground up, there are still some specialty pieces that you'll have to bring in some experts for.
Or even the smaller side, right? You bring in people to do a lot of the harder manual labor.
Yeah, exactly.
Right.
Yeah. So it's very much, anything in this space it's very much about the team. But that's especially true on the larger deals, right? There's absolutely no way to do these by yourself. And one of the reasons we like syndication is because it is that team investing. And so it's not just like we're going to do all of the work, or we're going to find people to do all of the work on this small thing, but it's no, we're going to partner with other folks to go really to bring collective capital together to purchase something that we might not otherwise be able to pull off. And then using not only partnering with others to bring the capital, but now partnering with an operator who themselves has a team to help go and actually execute a business plan on, say, a very large apartment building. It's this giant collection of teams, and there's really no way to pull that off or pull off anything at a scale that's possible in this space. You just can't do it on your own. And so that's why I like when people ask, well, if they've never heard syndication, it's like, well, it's team investing. That's the best way that I like describing it. And I think it kind of sums it up very well.
I think
but
something on that note that's worth touching is just kind of learning from others' mistakes, right? I mean, if we go buy tomorrow a 300-unit apartment building, we're going to be bringing on partners who have bought thousands of doors themselves and still own thousands of doors. And so talking a little bit about how we can kind of learn from their mistakes and use the power of our network to either find deals, the credit fund we found through our network. It wasn't a Facebook ad or something. A JP Morgan banker didn't tell us about it. Talk a little bit about the network we have and how we're going to use some of that on this podcast to try to bring that knowledge out to everyone.
Yeah. I think you and I we're both blessed to have a very strong network. I think that's something we both intentionally sought out. There's kind of a trite saying that your network is your net worth, but it's also very true for several reasons. And that's something that was very important to me, kind of coming from a non-real estate background and not having a lot of experience in the space. I wanted to get around folks who were, I obviously want to be around people who are at a similar stage as me, but more importantly, being folks who have already been there, who've done that, who have the battle scars, who can tell me, here's what you need to avoid, or, oh, watch out for this. It's invaluable, and it very much collapses time frames, speeds things along. And we've got a very strong network of folks who are way past where we are now, and are definitely where we want to be. And it's been very good for us, I think, to be able to call on that network in different situations as different deals come up. Again, as we get more experience and do things. Obviously, that's good, but it's still nice when there's some situation that we've never seen before, and we've got a fairly thick list of people that we could start calling through for advice on how to handle that. And that's really one of the reasons. I don't know if we want to transition to this yet or not, but that's one of the reasons we wanted to start this podcast, is not only just to we don't want to hoard this knowledge to ourselves, right? We do have a fairly deep network, and we want to be able to bring that knowledge, those resources, that learning to our investors, to potential investors, just to the world at large, to get a better sense of what to look out for, what to watch for, the questions to ask, some of the stuff that I was talking about earlier, to really, again, collapse timeframes and avoid stepping in those giant holes and making a mistake early on, or really any time in your investing career.
I think that's a pretty good summary of why we're creating this, what we're going to be talking about. Obviously, if you were questions and articles that we review, we can dive into those. But do you want to kind of take us through what the rest of this is going to look like, right? What the next few episodes are going to be, and how people can engage with us? Yeah,
absolutely. We I think we're still figuring this out, and we're obviously going to look for feedback from listeners. And if you're watching here, you leave a comment on YouTube or whatever platform you're watching this on. We certainly looking for feedback to try to improve this and have the show, have this content be something that folks are going to be looking for and they're going to find valuable. But I think our plans, we mentioned guests, right? We certainly want to tap our network. We've kind of got we've got a fairly long list of folks that we want to have on. I think we'll be in a position to do that and really bring some value from just our network. So guest interviews, us talking through some things in the news, maybe some more topical, some more timely things, just kind of what's going on, our perspective, what we're seeing, what we think is relevant to investors. Deal reviews, a common mentor of ours likes to say you get good at looking at deals by looking at deals. And so I think we want to do that, whether it's one of ours or it's someone else's, something that we happen across. I think we want to just do a deep dive, look at the kind of go through things as we would look at it and show the points. This is what we're honing in on. Here's the questions we would ask. This is what we like, what we don't like. Really just to try to provide an example of if you're just getting into this space and starting to look at private deals, here's what you need to watch out for. Potentially other episode types, but I think those are going to be the big ones. Maybe some of you and I just talking through a certain topic, something that's top of mind or that's important to us that we feel like we've seen and we want to address. But varying styles, but all with the idea of, again, bringing value, collapsing timeframes, trying to share some of the things that we've learned on our own, things that we wish we knew when we started investing. Even though we're on the active side, we still passively invest in deals. And so, things that we wish we would have known, or how being on the active side has changed the way that we view passive investments as well. So that's kind of the types of episodes we're going to produce. As far as engaging with us, you can probably the easiest place is just to go to the website. We're wealthindependencepod.com. We'll have show notes. We'll have links to all the recordings, YouTube, Spotify, Apple Podcasts, our social profiles, things like that. So really any way you want to get connected with us, that's going to be the best place, the one-stop shop to go for everything you'd possibly want. And Adam, is there anything I missed? Anything else you would want to cover?
No, I think we got everything. So appreciate everyone for listening, and remember, where freedom leads, real wealth follows. Join us next week.
Thanks, everyone.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.